What can you get for $3,000 a month in the Sacramento Metro? Guys, it is getting to be one of those things where people are questioning the affordability of Sacramento. So today, Aaron and I are going to talk a little bit about affordability. $3,000 is a price we're playing with today because rents in Sacramento, that's kind of what it's looking like for rents. A lot of people want to jump into a home, but they don't want to go too high over what they're paying for rent. $3,000 is the number, and we're going to talk to you in this video about what you can get for $3,000 a month, where you should be looking, credit scores and all that stuff in the Sacramento Metro. Aaron, what do you think about this? Is this doable?
Yeah, absolutely. It's doable. I think that there's just, there's some different things that have to be considered. And, we'll dive into each one of these things, but, in a nutshell, you got to be considering how much you're borrowing, or really like, what is your down payment amount? Obviously, the more you borrow, the higher your payment. And that's going to impact, that $3,000 goal that we're talking about. You also are going to have to consider where your credit is. And although you certainly do not have to have perfect credit to get a home loan, it doesn't hurt. And ultimately, having better credit or perfect credit or whatever is going to give you lower borrowing expenses. So, your rate's going to be lower, your PMI is going to be lower. And then I think the last thing that, you and I need to really talk about, and this is more of like, this is a harder conversation to have, I think, is really like your location matters. And a lot of that has to do with, like, I was talking to a person earlier today. They called into my office and they want to move to Rockland. And we started breaking down their budget and really kind of doing like some of the same stuff you and I are about to do here. But, just taking them through the process of trying to essentially like figure out what's realistic. And, ultimately, like with that individual, we determined that, about a $500,000 sales price was what's realistic for their budget and what they could qualify for. And, if you do a quick search and look at the Rockland Roseville area, it's kind of slim pickings, or there's no pickings in those areas. And so location really does matter. And so I think that's something else that is definitely needs to be a part of the conversation, whether it's resetting where you think that location needs to be or whatever the case. It's definitely a part of the conversation. So what do you say we dive into, essentially that down payment portion? Like, hey, if you've got X amount of bucks for your down payment, approximately, like how much, home could you buy? Does that sound good to you?
Well, let's first define out like a good credit score. Like, let's talk a little bit about like, what's a good credit score? A lot of people have great credit scores, yes. But what is that good credit score that you think that we'll be shooting for in today's example?
Well, I mean, ideally, you would have a 800 or higher FICO score, but not everybody's going to have that high of a credit score. It really is going to come down to if you have private mortgage insurance or not. If you're putting 20% down and you're not going to have PMI, then any credit score over 740 is just kind of bragging rights at the cocktail party. It doesn't get you a better interest rate with Fannie Mae or Freddie Mac. But if you're getting PMI, private mortgage insurance, which is going to be required if you're putting less than 20% down, then your FICO score, anything below 800, it does start costing you more per month. So, depending on ultimately what your down payment is, that ideal perfect credit score is going to be somewhere in that like 740 to 800 range.
Okay, so we got 740 to 800. That's what we're shooting for. Now, here's the thing, guys. Not everyone's got perfect credit. Not everyone is like that. But here's the thing. Maybe right now is not the perfect time to buy for you, but maybe in the future, 6 months to a year, credit is something you can definitely work on. Working with a lender like Aaron he'll basically be your personal trainer as far as finances go to get you kind of in shape, debt to income, all that kind of fun stuff. So if for some reason you're thinking to yourself, hey, look, I don't want to buy right now, or I can't buy right now, credit score is way too low. You don't ask. If you don't ask, you don't know. And you should start getting down the path. Like, let's say you're thinking about buying maybe a year and a half out, getting on top of your credit. It's not a fun thing and it's a little intimidating, but it's something you should start to look for like now. Okay, so we're talking about $3,000 a month. We're trying to aim for between 740 and 800 for his credit score. Now, in order to get us into like, let's say a $500,000 home, what is that looking like as far as for down payment for FHA and conventional? What do you think? Let's maybe 20%?
Yeah, 20% down, which, if you're going to do 20%, you're probably not going to do FHA, but there are scenarios where that might make sense. But, at 20% down, you're going to be at about 3,000 bucks per month when we include your property taxes, your homeowner's insurance, if there's any other costs. You're going to be a $500,000 sales price, 3,000 payment, 20% down.
Okay, so one of the things that kind of intimidated me a little bit with my first home was the fact that like I wanted to aim for like what was on monthly, out the door, taxes, all that kind of stuff. I wanted that one payment because for a lot of people out there, rent's a little bit easier, right? Rent's kind of like, hey, this is your rent check, here you go. For homes, a lot of home people, especially first time home buyers, don't want to be caught with a lot of gotchas. Like, oh yeah, hey, 3,000, yes, but this is a little extra, that's a little extra, this and this and this. So how do you factor in? Are there any kind of gotchas as far as what are the additional costs after the $3,000?
Well, so that's a really great point that you bring up. When you're looking at advertisements for mortgages or financing, you got to read the fine print just like everything, right? You and I, what we're talking about right now, I'm including those gotchas basically, which are typically property taxes and homeowners insurance, because you're going to have to pay those things regardless of who you do the loan with or what house you buy. You're going to have to pay those things. That's just part of owning real estate. But a lot of people, what they do is they build that into their mortgage payment. It's just part of the payment every single month. And, it's kind of like a set it and forget it. That's really the best solution for most consumers. So when I talk mortgage payments, I always like to include like your all-in payment. But you might have some additional gotchas that you got to watch out for, especially in Northern California, which comes down to your flood insurance and potentially additional fire insurance, which, it's kind of crazy. Some of the areas that are requiring additional fire insurance, it's not really like where you would expect there to be fires. But that's just kind of the way that the world of insurance works these days. And so you really got to figure out what your total cost of ownership is going to be and build that into the monthly payment. That way you don't have a gotcha, like you're saying, where you wake up one day and you got a bill in the mail for a few grand that you weren't expecting. Nobody wants that.
Well, the other thing too is like if you are moving into like an HOA community, that's kind of separate from the 3,000. That's something that you're going to have to deal with. Now, a lot of times too, if you get into an HOA, then maybe it's a condo community or whatnot that you have to do a lot of like group projects, let's just say, and you have to come out of pocket. It could be a bad space to be in if you put 20% down on a house and that's all you got. Not to mention moving into a house at times, like there's moving costs, there's like movers, there's like, landscapers, there's cleaner, there's a whole bunch of stuff that comes in like home maintenance and moving into a home. And additionally, some of the people who are moving into houses like if you're moving from an apartment to a house tends to be a little bit bigger of a space. And so that's additional furniture. So what would you say? Okay, let's say someone had maybe 30% in the bank that they could put down on a house. They're thinking 20%. Do you think that gives them enough cushion as far as like, should they be putting 20%? Should they put in 10, 15? What would be your suggestion to that person? How long do they have to save and how much should they save before actually pulling the trigger on a house?
Well, everybody's scenario is obviously different. And although I'm not a financial advisor, nor do I pretend to be one on YouTube, I would make the argument that you're better off putting less down if you can afford the monthly payment and keeping your capital, your money in your investments, working and growing for you versus basically being trapped in your home's equity. But your monthly payment has to fit within your budget. So one of the questions that I always like to ask when we're doing the initial application, the initial interview to really kind of like run our fact-finding mission, trying to figure out what the client's goals are, one of the questions that I always like to ask is what they're actually comfortable with. Because just because you qualify for a $6,000 a month mortgage payment doesn't mean that that's what you want your monthly payment to be. So part of the idea is figuring out what that payment goal is, and then trying to align the rest of the pieces to the puzzle together to where the purchase price is right, or, the HOA dues don't exceed, the amount, or the fire insurance, or whatever the case is, so that we're not running into a scenario where, you're now exceeding your payment goal. But as far as, is it enough? Something else that I think that people grossly underestimate is the cost of owning a home. If you buy a fixer upper, by definition, it's a fixer upper. It needs fixing up, and right. And those things cost money. Even if you are a, skilled tradesman, you're a handyman, you're able to, flip on the old YouTube and figure out a nice DIY project. Home Depot is not free, and neither is your time, right? And so you got to factor in the cost of this fixer upper, or be okay living with the, lime green countertops or the shag carpet or whatever it is that you'd be replacing. But I think a lot of people, they get into a home, they're just trying to get into the door, or maybe they're really kind of stretching, into a neighborhood or into a size of a home that's maybe a little bit beyond. And the way that they make their budget work is they buy a home that needs a lot of work, but then they don't have the money to do the work. So, if you had 30%, depending on the situation with the property, maybe only putting 5% down makes sense, because you're going to need 20% or 15% in home improvements. Whereas, some of the houses, like we've helped a lot of clients get into homes that are like what you would call turnkey, where it doesn't really need anything to be done, right? In those circumstances, you're not going to need as much for that. So maybe you throw more towards your equity or your down payment, or, you subscribe to the school of thought that I threw out there, where you invest more. But either way, your down payment, really, there's no like silver bullet. It's really looking at each person's individual scenario, which if you want to look at your scenario, reach out to us. We'd love to help you. But figuring out basically what, the magic number is with down payment, budget, location, all of those things, to ultimately determine what the purchase price is that you should not exceed, so that you stay within your limits.
Okay, so now let's talk about a little bit of a qualifier, right? To actually get a pre-approval that says you can qualify for a house, it's, let's say, like $500,000, $3,000 a month. What are we talking about as far as like income? Like, how much do you need to make? How long do you have to be at the job? All that kind of fun stuff.
Yeah. So as far as being at the job, I mean, the employment history, they're going to be looking at 2 years, basically, your last 2 years. Now, that doesn't mean that you have to be at the same exact employer. You could have worked at multiple employers, or maybe you're self-employed and you've been self-employed for 2 years. Basically, they're just looking for the last 2 years of history, stringing that together. And depending on what that history looks like, that'll kind of dictate what income you're allowed to use when qualifying. Like if you're commissioned or if you receive bonuses, that works differently than if like you work for the state of California and you get a fixed salary every single month. But let's say that you're trying to purchase that house that's, going to be a $3,000 a month payment. You're going to need to make at least $6,000 per month to qualify. But that would be assuming that you don't have car payments, student loans, credit cards, other like personal loans, installments, things that will show up on your credit report, basically. If that were the case, then let's say that you had like $1,000 in other payments, and then we're talking about a $3,000 a month total mortgage payment. So $4,000 total. You would need to make $8,000 per month or more to qualify. Most programs will allow for up to a 50% debt to income ratio. FHA, believe it or not, they actually go to 56.9%. But ultimately, it's not a given with them accepting that much. There's a computer algorithm. Everything's decided by a computer program these days, right? And it's no different with your home loan. Fannie Mae's DU or Freddie Mac's LP, when your application goes through their algorithm, if it likes your scenario and accepts the risk, then it will take a debt to income ratio up to those amounts, like about 50%. So That's approximately what you would need to make in order to qualify for, a home. So if you're talking a $500,000 home, you need to make, call it 96,000 bucks or so per year in order to, if you had your 20% down payment, have your $3,000 a month mortgage, you need to be in that range.
Okay, so one of the questions I get asked a lot, and this is a big one, right? Is like I get a married couple, and one of them has like 800 credit and they're loving it, and the other one has maybe like low credit, like we're talking like 560 or like 570. Like, how does that? Is there any kind of ways they can get away from that? I mean, is it kind of like what does that look like as far as applying for a loan?
Oh man, I've never come across that scenario before. Let me guess, the husband has terrible credit and the wife has rock star platinum credit. That's the way it almost always works, by the way. Unfortunately, there's not a simple, silver bullet solution to it. Ultimately, if the husband, for instance, has the income but has the low credit score, and the wife has a high credit score and no income, well, you need income in order to qualify for a loan. And so the way that it would work is they're going to use the FICO score of the lower out of the two. So, if husband and wife are on the loan application together, husband's score is going to dictate what rate they get, what PMI they get. This is where it's important that your mortgage professional is not just an order taker, where they're actually reviewing your credit report. And if there's areas for improvement, basically to make it to where you can get a better rate, to where you can get cheaper PMI or whatever the deal is, qualify for more. They need to be looking at those scenarios and then providing advice to you on things that you could do to improve your credit score. We do that with every single application that we do here. And sometimes it can be as simple as like, hey, Mr. Smith, you've got a credit card that currently has a $2,000 balance. Can you pay that thing down to $1,600? So $400, pay it down by 400 bucks. Don't use it, pay it down 400 bucks, and then let me know when it's paid down, and I'm going to update your score. And we've got a system, all lenders do. Most lenders are just lazy and they don't want to do the extra work, right? Nobody ever wants to do the work. But if you find a lender that wants to do the work, a lot of times there's a path that in most cases isn't, building rocket ships. It's an easy solution to bumping up your score. Maybe it only needs to get bumped 20 points, 40 points, something like that. That's not a big deal. Now, if it's a scenario where, the credit is just trashed and, we need to take you into ER and do triage, well, it's possible at that point, that's where we pull in a professional. We're just by nature, we work with credit repair agencies, and there's actually some really great credit repair companies. Not all of them though. Some of them are crooks. So don't just go sign up with anybody, but there are some companies for a reasonable fee will leverage the Fair Credit Reporting Act, which is basically a law that dictates how the credit agencies and creditors have to respond to disputes the consumers make. That's one of the pieces to it. And so what these credit repair companies do is they basically, work within the law, and they try and, basically inundate the creditor and the credit agencies with disputes and various tactics that make it to where they got to drop things off of your report, basically. So depending on the credit scenario, maybe there's a quick fix. Maybe it's going to take a few months, but you did bring up a point earlier where it's like, hey, if you're planning on buying a house 6 months from now, 12 months from now, 2 years from now, whatever the case is, and you know that your credit's not perfect, don't wait until the day comes when you want to buy the house. Reach out now so that we can figure out, what is needed in order to get your credit to the optimal scenario. That way you got plenty of time to get it done. I've seen way too many times where people wait until they found the house that they want to buy, their dream house. They've already moved in. Their wife has already picked out all the furniture, the kids' schools, all that stuff. But they haven't taken care of the basics, the foundational stuff like credit. and they waited until the last minute. And because sometimes it can take a while to fix things, not everything's an instant fix these days, right? Never has been. But let's say it takes a couple of months, and while you're waiting for your scores to jump up to where they need to be, that house sells. And now you're heartbroken, your dreams down the drain. And if you would have just done things up front and been prepared, you would have been in a position to be able to, to take advantage of the opportunity. So I would encourage anybody that's watching that, if you're listening to this, you're like, oh, that kind of sounds like the scenario that I'm in. Don't wait until the last minute. Reach out ahead of time. That way you got a strategy, and you'll set yourself up for success.
Okay, I agree with that. I mean, education and figuring out like where you're going as far as like home ownership is definitely a priority and should be. I know it's scary at times. It can be like going to the dentist if you haven't gone in a few years, or even like at the IRS. I mean, it shouldn't be, because the reward is really good at the end of the rainbow. Now, okay, let's talk a little bit about this. Aaron, go into a little bit of like which interest rate, because I want to make sure that everybody knows, because this video could be watched like in 3 years from now. As far as our scenario for $3,000 a month, what interest rate are we playing with today to kind of, what rate are we putting in the calculator so people can know comparatively towards what the rate is in 2026?
Sure. So in these scenarios, I used a 6.5%. Sure, right now rates could be a little bit higher, could be slightly lower, depending on the lender you're working with or your FICO score. I kind of just picked an area kind of like in the middle, a sweet spot. So as rates come down, that'll obviously increase your buying power, and it'll move up, so instead of 20% down getting you, a $500,000 house with a $3,000 payment, as rates come down, maybe it's a 550 or 600. So you definitely, that's one of the reasons why if, you are planning on buying a house, whether it's today or years from now, you need to be in tune with what's going on with the market. Because if, let's say, rates are, all of a sudden drop, and you're now in an affordability price point where you can take action, all the stars are aligned, who knows how long rates are going to stay where they're at. We've seen, over, the last 20 plus years, it's like a roller coaster, some days up, some days down. And depending on what's going on in the world, they, shoot parabolically in certain directions. So, kind of the theme to all of this is really just being prepared and being ready to be ready.
All right. So let's do this. Let's say they're single. Let's say they got good credit. So we're above the 740, let's say 750, okay? They make $100,000 a year. Maybe they're buying now, or maybe in a year from now, their credit is up to this level and everything too. Now, a lot of people, because of recession, because the economy, don't have a lot of money in the bank. So let's go. Okay, so you're saying right now at the 6.5 interest rate, we're talking as far as they can get a $500,000 house. Now let's say they have no money in the bank, and they're saying, look, I want to get into something. I want to stop paying rent. I'm going to use that 1% down payment assistance program. So we're talking the high is $500,000. If they're going in with like no money down, they're getting assistance, or, they just have some little bit of money to put in there. What does it look like if they're going in for 1% in, and they're trying to still keep at the $3,000 a month? What does that look like as far as, that way we can analyze some areas, properties and everything too. So what does that look like?
Yeah. So at a minimum down payment, which would basically be 3% is your minimum down payment. And then if we tack on some additional down payment assistance or maybe some grant money, that gets you down to maybe 1%, or, maybe even no money down. Every little scenario is a little bit different, but approximately at $3,000 per month, when you factor in your PMI, your property taxes, that homeowner's insurance, you're going to be at a price point of about $365,000, give or take, at the 6.5% interest rate. Now, something I'll point out, because we help out a lot of people in this price point. There's a lot of entry-level buyers, a lot of first-time buyers. At this price point, especially, if you're edging into areas, neighborhoods that are at a much higher price point, be careful for HOA dues. That's something that often gets overlooked. At that price point, you're going to find a lot of condos, for instance, and there are some really great condos out there. but condos have homeowners association dues. So if you're trying to keep that monthly payment, that total nut at $3,000 or less, you got to factor in those HOA dues. And like Mark, what you were talking about earlier, depending on, how well that HOA has managed the property, those dues can fluctuate every year. And we've seen it where it shoots up dramatically because of mismanagement with repairs. And then all of a sudden, they got to put a new roof on the whole complex, and that costs $500,000 or whatever the case is. So definitely do your due diligence when considering, an HOA and those dues. But you got to make sure you're factoring it all in. But call it 360,000 would be like your entry level price point with a minimal down payment, while keeping your monthly at 3,000.
Okay, so let's have a little fun now. Now the idea is we're talking 365. My thought is, and Aaron and I talked about this offline, if you're dead set on a house for 365, I think like my own opinion would be looking at like in areas like Linda, Marysville, Plumas Lake. I think that area is still pretty affordable, and you can get like a nice house, 3 and 2 or 4 and 2 out there. I think for like $500,000, I'd say you could probably get yourself a 3 and 2 in areas like maybe like West Roseville with newer building. I'd say $500,000. If you're at $500,000, areas like Old Roseville are definitely there. Areas like Natomas, Rosemont, areas that if you buy there, after a while, if you decide that you want to move somewhere, you'll probably keep the property because they're in areas that are going to be nice little investment property and nice little pockets. Maybe not as much the Linda or Plumas Lake right now, but maybe in about 10, 15 years, the growth could be pretty good there. So, that's kind of what I'm looking like. As far as Aaron, as far as this price point, what would you go for 500? What would you go for 365? What areas would you put people in?
Well, I definitely in the greater Sacramento market, I like the 95826. That's going to be like your Rosemont, College Greens area. It's right off the Highway 50 corridor, so it's close to a lot of employment sectors. And, you can get into a pretty decent home at a pretty fair price point. And you're now participating in the market. Something that I want to point out is that home prices are not frozen in time. In fact, if you look at the last 60 years, home prices appreciate on average 5.37% every single year. And so like, for example, I've got 2 clients, one actually closed earlier today, already got my 5-star Google review. Thank you, Nancy. And then I got another one closing later this week. Both clients are putting massive down payments. Like one, the Nancy today, she put like $500,000 down. Is it because she's a baller? No. Did she win the lotto? No. Did she inherit a bunch of money? No. What did she do? She owned real estate. She owned her previous residence for like almost 20 years. And it's just over time, 5.37%, compounding year after year after year. And so the reason that I bring that up is that getting your foot in the door into real estate where you actually own something that's appreciating, that is the secret. That's the key to buying your dream home. Like the most realistic people, like, it's not like you're going to just fall into something. All of these transactions that you hear about where you see people are buying their dream house and they're putting these massive down payments, every single one of them, maybe there are some exclusions, but the overwhelming majority, where's their down payment coming from? It's their departing residence. They sold the home that they've been living in for the last 10, 15, 20 years. And because of that, they can afford to go buy $1 million house or, whatever the case is, because they got a massive war chest that they built up in equity. So whether it's moving to the 95826, because you can get into entry level, or doing what Mark suggested and like going on the outskirts of town, I really like the Linda, Yuba City, those areas, those are definitely up and coming, and it's within a reasonable commute, especially if you work in like downtown Sacramento, something like that. But I would encourage you to, spread your, geographic map out a little bit further and consider areas that you might not have been considering beforehand, because they're going to be cheaper. You'll probably be able to become a homeowner much sooner, which means that you'll start building equity much sooner, And then ultimately it'll get you towards your final goal, which is to have a dream house. That's kind of what everybody's little dream is, right? Like, I want to move up into the hills on acreage. When I do that, I'm going to take my big fat down payment from the house that I've owned for several years. It's not like, I won the lotto or something. So that's how everybody does it.
Well, looking at the numbers and everything too, I think $500,000 in Sacramento, I think it's doable. Or you can get your dream house or something you've been always wanting. I mean, you're going to get a house. And I think that there are certain areas that you have to look at. And I think the $500,000 price range is super hot and super competitive right now in our area. So it's a tough one, right? Is it doable? I think it's definitely doable. And it's nice to know that if you're putting 20% down, you can get there about $3,000 a month, because I think that answers a lot of people's questions. Is Sacramento still affordable? Like I said, 365, that's a hard one. I'd say like you're looking at maybe a 2-in-1 in the Sacramento area. I think that's definitely doable. I think maybe a duplex, you can probably swing that in Sacramento. But like I was saying before, I think the outskirts of the city is where you're going to be looking at. And like I said, guys, back in the day, Roseville was on the outskirts, Folsom was, and then all of a sudden we had a boom, and next thing you know, they're the places to live. So I think you probably could see a boom like in areas like, Yuba, Linda, Plumas Lake, because affordability is one of the main blocks that built Sacramento to where it is right now. I think areas like that are great, and I think eventually everything is going to close. Everything is going to be closed. The gap is going to be somewhat closed in those areas as well too. And you might not see 365 pricing in areas like Yuba and Marysville and like Linda sooner than later. You can even get something brand new for 365, which is kind of unheard of. I see a lot of similarities in those areas that I saw maybe in Sacramento 7 years ago, and I see that even changing in those areas. So just, it's kind of nice to know about 3,000. So Aaron, final parting words for $3,000, what you can get in the Sacramento area.
I would say to anybody that's watching this, considering, does this make sense for me? Does $3,000 a month and these budgets that you guys are talking about make sense? Ultimately, your scenario is not going to be the same as the next guy's scenario. And what you really need to do is have a conversation with a friendly professional like myself. It doesn't cost you anything to talk to us, by the way, but basically figure out exactly what your real numbers are so that you can align those with your goals and figure out if being a homeowner makes sense for you, and you can make an educated decision for yourself. So please feel free to reach out.
Okay, guys, like I always say, don't time the market, time your own life. But if your own life is telling you I can afford $3,000 a month, this is what you can get in the Sacramento area. Again, guys, hopefully you enjoyed this video. Like, subscribe, and comment. Until next Monday, where I show up with Aaron and we give you a little bit of valuable insight on the Sacramento real estate market, on the real estate industry, and mortgage in general. See ya.